Imagine a time not so long ago when Asia was the undisputed economic superstar. Nations like Thailand, Indonesia, Malaysia, South Korea, and the Philippines were dubbed Asian tigers for a reason. Their economies weren't just growing, they were exploding, seemingly unstoppable. Factories hummed, skyscrapers soared, and foreign investment poured in like a tidal wave, eager to capitalize on this meteoric rise. Everyone wanted a piece of the action, from global corporations to individual investors. It was an era of unprecedented prosperity, fueled by high exports, low labor costs, and ambitious development projects. Optimism was sky high, almost intoxicating. People believed the good times would never end, that this growth was somehow different, immune to the old rules of economics. Foreign capital flowed freely, banks lent aggressively, and asset prices skyrocketed, creating a dangerous bubble. Beneath the gleaming facade of progress, however, dangerous cracks were forming, hidden from plain sight, ready to unleash a storm that would shake the world to its core. A financial hurricane nobody saw coming, or perhaps chose to ignore until it was too late. The first tremor struck in the quiet corners of Thailand. For years, the Thai baht had been pegged to the US dollar, providing a sense of stability that attracted massive foreign investment. But behind the scenes, a different story was unfolding. Property bubbles grew to unsustainable sizes, and banks accumulated mountains of bad loans. Speculators, sensing weakness, began to short the baht, betting its value would fall. The Thai central bank desperately tried to defend the peg, throwing billions of dollars from its reserves into the market. It was a valiant but ultimately futile battle. On July 2, 1997, the inevitable happened. Thailand was forced to float the baht. The currency immediately plunged, losing a significant portion of its value overnight. This wasn't just a currency adjustment. It was an earthquake. The proud tiger had stumbled, sending shockwaves across global financial markets. Nobody realized yet, but a Pandora's box of financial chaos had just been opened, marking the beginning of a truly terrifying new chapter for Asia and the world. The fall of the Thai baht wasn't an isolated incident. It was the spark that ignited a regional firestorm. Investors, spooked by Thailand's collapse, began pulling their money out of other risky Asian economies at lightning speed. Indonesia, with its immense foreign debt and weak financial regulations, was next to crumble. The Indonesian rupiah plummeted and panic spread like wildfire. Then the crisis hit South Korea, another economic powerhouse. Its massive conglomerates, or chaebols, had borrowed heavily in foreign currencies, betting on continued growth. When the won's value tanked, these debts became astronomically expensive overnight, pushing countless companies to the brink of bankruptcy. This wasn't just a financial downturn. It was an unprecedented cascade of fear and capital flight. The rapid unraveling exposed deep structural flaws and reckless borrowing practices that had been masked by years of seemingly endless prosperity. The world watched in horror as one nation after another fell victim to the contagion, their once vibrant economies suddenly facing an existential threat.
Imagine waking up one morning to find your national currency, the very bedrock of your country's economic stability, has lost half its value. This wasn't a hypothetical nightmare. It was the brutal reality across Asia during the crisis. As foreign capital fled, the demand for local currencies evaporated, sending their values into a nosedive against the US dollar. The Indonesian rupiah, for example, plunged from about 2,500 per dollar to over 16,000 at its worst point, an astonishing 80% loss. The Thai baht, Korean won, and Malaysian ringgit suffered similar, though slightly less extreme, fates. This wasn't just an abstract economic indicator. It had devastating real-world consequences. Imports became prohibitively expensive, fueling rampant inflation. Businesses that relied on imported raw materials faced impossible costs. And for millions of ordinary people, their savings and purchasing power were wiped out almost overnight. The very foundation of their financial lives crumbled, leaving widespread desperation and despair in its wake. It was a brutal, swift destruction of accumulated wealth. The currency collapse created a second, equally devastating problem, a massive foreign debt crisis. For years, Asian companies and banks, confident in their booming economies, had borrowed heavily in U.S. dollars and other foreign currencies. These loans seemed cheap and manageable when their local currencies were stable, but when the baht, rupiah, and won plummeted, the amount of local currency needed to repay those dollar debts skyrocketed. A company that borrowed $1 million suddenly owed the equivalent of $5 million or more, practically overnight. This wasn't just an inconvenience, it was a death sentence for countless businesses. Solvent companies found themselves instantly bankrupt, unable to service their foreign obligations. Factories stood idle, construction projects halted midair, and job losses mounted at an alarming rate. The once proud engines of economic growth were now paralyzed, suffocated by an insurmountable wall of foreign debt. The crisis brutally exposed the vulnerability of economies that had relied too heavily on short-term foreign capital.
With companies defaulting on loans and currencies in freefall, the region's banking systems began to crack under immense pressure. Banks, already burdened by massive non-performing loans from the pre-crisis boom, faced a double whammy. Their assets were shrinking, and their liabilities, often foreign currency debts, were soaring. Trust evaporated almost instantly. Fearing that their savings would vanish, ordinary citizens rushed to withdraw their money, triggering widespread bank runs. This created a vicious cycle. As more people withdrew funds, banks became even more illiquid, threatening their very existence. Governments were forced to step in with emergency bailouts, nationalizing failing institutions and pouring billions into shoring up the financial system. But these measures were often too little, too late, or simply not enough to stem the tide of panic. The once stable financial pillars of these nations crumbled, leaving behind a landscape of uncertainty and a profound sense of betrayal among the populace. The banking sector, the lifeblood of any economy, was hemorrhaging.
The economic devastation wasn't confined to balance sheets and currency markets. It ripped through the very fabric of society. Millions of people lost their jobs, their savings, and their sense of security almost overnight. Factories closed, businesses shuttered, and unemployment soared to unprecedented levels. Poverty, which had been steadily declining for years, surged dramatically. Families struggled to put food on the table, and the dreams of a better future evaporated. This widespread suffering fueled immense social unrest. Protests erupted in cities, sometimes turning violent, as people demanded answers and accountability. In Indonesia, the economic crisis directly led to the downfall of President Suharto, who had ruled for over 3 decades amidst widespread riots and social upheaval. The crisis wasn't just an economic event. It was a profound human tragedy that tested the resilience of entire nations, tearing apart communities and forcing drastic changes in leadership and governance. The price of economic collapse was measured not just in dollars, but in human suffering and shattered lives.
As the crisis deepened, the international community, led by the International Monetary Fund, IMF, stepped in with massive bailout packages totaling tens of billions of dollars. But this aid came with a hefty price tag and stringent conditions. The IMF demanded harsh austerity measures. Governments had to drastically cut spending, raise interest rates to defend currencies, close failing banks, and implement structural reforms. For many, these conditions felt like a bitter pill, deepening the pain for ordinary citizens and sparking accusations of foreign interference. Critics argue that the IMF's policies, particularly high interest rates, actually exacerbated the crisis by stifling recovery and increasing the burden on indebted companies. Yet, supporters claim these measures were necessary to restore confidence, stabilize economies, and prevent future collapses. Regardless of perspective, the IMF's intervention became a symbol of both desperately needed rescue and deeply resented intrusion, leaving a complex legacy that is still debated today. It was a choice between survival and sovereignty, with no easy answers. While the epicenter of the crisis was in Asia,
Its destructive waves quickly spread far beyond the region's shores. Global stock markets experienced significant downturns as investors feared a worldwide economic slowdown. Major international banks, heavily exposed to Asian debt, faced massive losses and tightened lending standards globally. The crisis also impacted commodity prices as demand from Asia's once booming economies plummeted. Countries like Russia, with its own economic vulnerabilities, were hit particularly hard, contributing to its 1998 financial crisis. Even the mighty U.S. economy felt the chill, though its stronger foundations largely protected it from a full-blown meltdown. The Asian financial crisis served as a stark, terrifying reminder of how interconnected the global economy had become. A problem in one corner of the world could rapidly morph into a threat to financial stability everywhere, proving that distance offered no immunity from economic contagion. The world learned a painful lesson about globalization's double-edged sword.
The Asian financial crisis left scars that took years, even decades, to heal. But out of the ashes, valuable lessons were learned, forever reshaping the global financial landscape. Nations adopted more prudent fiscal policies, strengthened their banking regulations, and built up massive foreign exchange reserves to cushion against future shocks. They diversified their export markets and reduced reliance on short-term foreign capital. The crisis also spurred greater regional cooperation and the establishment of new financial safety nets. While the immediate aftermath was devastating, the affected countries eventually bounced back, demonstrating remarkable resilience and adaptability. However, the memory of those dark days lingers, a powerful reminder of the fragility of prosperity and the importance of sound economic governance. The crisis taught the world that unchecked growth, speculative bubbles, and weak oversight can indeed destroy entire economies overnight, demanding constant vigilance and reform to prevent history from repeating its most painful lessons.